Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're diving into the U.S. stock market for July 31st, 2025. It was, well, a day marked by a pretty fascinating paradox. You had these early gains, some record highs even, but underneath, a broader struggle. Our mission, as always, is to take all the raw stuff, the market updates, company reports, expert chatter, and, really boil it down for you. We want to pull out the most important nuggets, give you that shortcut to understanding a complex day. We'll reveal the surprising bits and, crucially, help you get the why behind the what. So let's get into it and unpack these interesting, maybe even contradictory market moves. Okay, so let's unpack this. Today kicked off with some pretty strong momentum, but that shifted pretty quickly, didn't it? It became a much more complex picture for the wider market. Those early gains, which were really fueled by Microsoft and Meta hitting records, they just sort of faded in the afternoon. The NASDAQ, the tech-heavy one, it managed to hold on to a small gain, maybe 0.1%, but the S&P 500, that actually pulled back 0.1%. And both of them had, briefly touched record highs right after the opening bell. The Dow Jones, though, it had a tougher time, lost about 175 points. That's 0.3%.
Yeah, what's really striking there is the divergence you just described. It's quite clear you see the tech-focused NASDAQ finding support, holding its ground. But then the S&P 500 and the Dow, they were facing these headwinds. It really highlights how different these big benchmarks are constructed. Take the Dow, the 30 stock index. It's actually the only major benchmark that hasn't hit a new all-time high this year.
Yeah.
Still waiting. It's got that higher concentration of, let's call them value stocks. That's quite different from the S&P 500 and the NASDAQ, which lean more towards growth stocks. And we saw those growth stocks, particularly tech, really outperform in 2023 and 2024 rallies. On the flip side, the Dow often does a bit better when the market turns down, like we saw back in 2022.
Right. But the real story, maybe, or a big part of it today, was how just a couple of companies seemed to buck that broader trend. Two from that Magnificent Seven group, the mega cap tech stocks everyone watches. They really powered that early surge and pretty much kept the NASDAQ in positive territory. Microsoft, for instance, up a solid 4%. That was off the back of better than expected earnings. And here's a really big number. Annual revenue from Azure, their cloud service, it topped $75 billion. That pushed Microsoft's market cap to $4 trillion, puts them in that tiny club with NVIDIA. And then there's Meta Platforms. Wow, jumped 12%. They put out a really upbeat sales forecast for the third quarter, blew past what the street was expecting.
And if you connect that back to the bigger picture, the strength you see in these individual giants, especially that really strong outlook from Meta, it gets amplified by what analysts are thinking and saying. Like HSBC, they upgraded Meta to buy, slapped a $900 price target on it. That implies what? Almost 30% potential upside from here. And they're pointing to things like AI investment driving growth, better ad targeting, better content quality, more time spent on their apps, and just continued user growth. Those are the key reasons they cite. And just for context, Apple's sitting third on that market cap list, around $3.2 trillion right now.
And speaking of those tech titans, two more Mag 7 members, Apple and Amazon, they're actually reporting earnings after the bell Thursday. So potentially more tech influence coming right up. So, okay, while these huge tech companies were setting records, their massive pull just wasn't enough to lift the whole market, was it? It seems like a whole different set of factors were pushing the other way, kind of knocking investor confidence down a peg.
Yeah, one of the big things weighing on sentiment was this sort of reassessment of Fed policy. After the central bank meeting this week, a lot of investors seem unsure, will rates actually fall in September? Maybe twice this year. Still questions there. And that uncertainty got worse with the latest inflation numbers. The June PCE figures personal consumption expenditures. That's the Fed's preferred inflation gauge. Well, the 12-month rate came in at 2.6% for the headline number, the all items one, and 2.8% for the core reading, which strips out food and energy for a look at underlying trends. Both of those were just a touch higher, 0.1 percentage point, than the Dow Jones consensus forecast. And importantly, still above that 2% Fed target.
Now, the monthly increases were pretty much in line with expectations. We also saw personal income up 0.3%, a bit better than the 0.2% estimate, and spending rose 0.3%, slightly under the 0.4% expected.
It really underscores just how sensitive the market is right now to inflation data and, what the Fed might do next. Even a tiny miss, like that 0.1% on PCE, it can send ripples through expectations about interest rates. It just shows the nervousness.
Yeah.
And we also saw some political commentary directed at the Fed today. President Trump was quite critical of Fed Chair Jerome Powell on Truth Social, used some strong language, calling him too late, too angry, too stupid, too political, even a total loser for keeping rates where they are. It's probably also worth mentioning that two Fed governors actually voted against holding rates steady this time, so not unanimous.
Okay, so the macro picture, the Fed, inflation, Clearly a drag. But what about trade? Global trade stuff seems to be adding pressure too, right?
Oh, absolutely. Trade is definitely another major headwind right now. There's that White House deadline coming up Friday, potentially much higher tariffs on major trading partners, like India, Brazil. And then President Trump also kind of poured cold water on things by saying the 25% duty on Mexican imports, that's being extended another 90 days, which, contrasts a bit with comments from Treasury Secretary Scott Bessent. He suggested talks with China are getting somewhere, that they maybe have the makings of a deal. That's ahead of an August 1st trade deadline, and the current tariff truce runs out August 12th. So conflicting signals there. And these tariff worries, they hit companies directly. Ford Motors, a good example. They're forecasting something like a $2 billion negative impact, a tariff-related headwind on their 2025 earnings. That's significant. It prompted David Russell over at TradeStation to say the market might be, quote, losing its glass half full bias. Basically the reality of tariffs, maybe some seasonal patterns kicking in. He thinks investors have kind of ignored warning signs, like the last CPI report showing the impact of trade duties.
And Joseph Cusick at Calamos Investments also chimed in. He finds the market reactions, kind of hard to justify sometimes, especially with strong earnings and buybacks happening. But he did also note that the downside moves, the pullbacks, have been relatively contained so far, not a total collapse.
Right. So beyond the big index moves, the day was also full of these really interesting individual stock stories, really highlighting where money was flowing and, well, where it was flowing out. It really was a day of sharp contrasts, even down at the company level. Okay, on the winning side, first off, huge buzz around the Figma IPO, really strong demand. NYSE President Lynn Martin was quoted saying it'll open the floodgates for more listings. She mentioned almost $5 billion raised just from NYSE IPOs in July alone, her take. The market is finally back. We also saw Generac climb 5%. Bank of America raised their price target, pointing to Generac getting into the data center space. Integra Life Sciences popped 7%. They beat estimates for Q2, both revenue and earnings. Revenue was $415.6 million. Expected was $395 million. Adjusted earnings per share, 45 cents, a penny better than consensus. And C.H. Robinson jumped 9%. Their Q2 adjusted earnings were $1.29 a share, beating the $1.16 FactSet estimate. Plus, Baird upgraded the stock. Then in after hours, Alignment Healthcare just surged, up 20%. They beat Q2 expectations and gave strong guidance. Earnings were 7 cents a share. Analysts were looking for a 7-cent loss. Revenue over $1 billion, beating the estimate too. And their Q3 guidance looks solid. But then, the flip side, some really significant losers today. Baxter International shares dropped 10%. The healthcare company reported weaker Q2 results than expected and cut its full-year earnings guidance. And even more dramatic, Align Technology. Wow. Down over 30% today. That's on track to be its worst day since way back in 2007. This came after they missed earnings estimates $2.49 per share versus $2.57 expected. Revenue missed too. Morgan Stanley reacted quickly, downgrading the stock, cutting their price target by a huge 38%. They cited limited clarity on path from here and questioned if long-term growth can recover. Ouch. And finally, Moderna. They announced plans to cut about 10% of their global workforce by the end of 2025, pointing to slowing COVID shot sales and just general uncertainty in the vaccine market. The CEO, Stefan Bensel, said it was, quote, essential to remain focused and financially disciplined.
Yeah, this really just emphasizes how incredibly selective the market performance was. Even within this tale of two markets kind of day, opportunity wasn't spread evenly at all. It really forces you to look at the granular level, doesn't it? Understand the specific things. Is it AI investment? Is it supply chain strength? A change in analyst views? What's creating these big winners and losers almost regardless of what the main indexes are doing. And it shows up in the extremes too. You had 27 stocks in the S&P 500 hitting new 52-week highs today. Names like Meta, DoorDash, eBay, Microsoft, Nvidia, Oracle, GE, Vernova. Quite a list. But at the same time, 25 stocks in the S&P 500 hit new 52-week lows. Charter Communications, Chipotle, Lululemon, General Mills, P&G, Align Technology, obviously, Accenture. So really pulling in opposite directions.
So that's the fractured picture inside the U.S. market today. These extremes of success and struggle playing out side by side. But to really get the full context, we need to zoom out a bit, right? How did the rest of the world look, and how did this pretty tumultuous day wrap up the month of July overall? Well, looking overseas, Asia-Pacific markets were mostly down on Thursday. Mixed, but mostly lower. Hong Kong's Hang Seng fell about 1.5%. Mainland China's CSI 300 down 1.8%. South Korea's Kospi lost a bit. Two-way at 200, down 0.16%. India was a bit of an outlier. The Nifty 50 up slightly. Sensex basically flat. And looking back at the whole month, today, Thursday, was the last trading day of July. And overall, it was actually a strong month for Wall Street. Despite today's choppiness, the S&P 500 gained over 3% in July. The Nasdaq did even better, up about 5%. And the Dow managed to climb 1%. So let's try to wrap this deep dive up. July 31st, really defined by that stark contrast, wasn't it? You had incredible tech strength, especially for Microsoft and Meta, kind of holding up the NASDAQ. But the broader market was definitely feeling the weight of those bigger macroeconomic worries. Fed uncertainty, trade tensions heating up again.
Absolutely. I think the key takeaway is this deepening split, this bifurcation in the market. It feels like it's not just about growth versus value anymore. It's more about the just immense gravity of a handful of tech giants. They're being pulled up by these big long-term trends like AI, while the rest of the market is kind of wrestling with these macro headwinds, these economic pressures. What we saw today really just highlights that ongoing search for balance, between strong company stories, especially in tech, and these wider economic and geopolitical uncertainties that just won't go away.
It was a really layered day in the markets. Fascinating to watch unfold, wouldn't you say? So here's something to think about. What does it really mean when the overall market is struggling, kind of treading water, even while individual giants are hitting all-time highs and we're hearing about IPO floodgates opening? Is this a sign of a fundamentally split market where maybe only a few huge companies truly drive everything now? Or is it just a temporary thing, a divergence caused by these specific factors we talked about today? Something to mull over.